Welcome to the Southeast Region Row Crop Team of Texas A&M AgriLife Extension's monthly cotton and grain marketing update. My name is Matt O'Shea. I am the County Extension Agent Agriculture in Victoria County, and we're glad that you're with us this morning. We have a good program for you. It's an ongoing program. It's a monthly program. If you're interested, you can tune at this time, or you can catch a recording of it that's sent out via the county extension agents. We'd like to thank our sponsors that bring this program to you each month. That's the Cotton Board, the Texas Corn Producers Board, and Texas Sorghum. We greatly appreciate their interest in this program and continued support of the program. We're going to kick things off real quickly this morning with Mr. Wayne Cleveland. Mr. Cleveland is the Executive Director of Texas Sorghum Producers, and we will give you the floor, sir. Good morning to you.
Thanks, Matt. No slides this morning. I think everybody's about slided out in my world. So what I did want to do is touch on just a few policy topics and some things that are going on around our industry. First, we're aware of the grading situation in South Texas. We've formed a task force to address that. Certainly that's a long-term issue that we've dealt with, but we continue to monitor that. We'll uptake that at our meeting in December to see what we can do to help it along. But, kind of our numbers indicate that over the past 10 years, the damage in the coast usually amounts to less than 1% of the total crop in the nation. So it's an uphill climb to change things that have such a minimal effect on the overall. Basically, we're an outlier. So if you're a statistician, you'll enjoy that. But we are working on that, as well as other cultural issues such as variety maturity. A&M Crop Test has an incredible website with all the varieties on it that'll guide you to what those shorter maturities produce. I think they're probably worth looking at after a year like this. But we're starting to see the grain move again, which is really good. We're seeing grain with up to 40% damage move into the port there in Corpus Christi, which basically means grain's moving out of the north. It's probably number one, number two quality. There's a lot of money to be made by mixing those grains and shipping them out. Also, what that tells us is ADM's open, they're buying, so most likely China purchases will show up tomorrow in the USDA report. We're about 90% where we were this time last year as far as China purchases. It's moving along really slow. It's quiet. The price continues to hold. We're seeing 50 cents plus basis increase on the high plains. Ethanol plants have cranked back up there, two of them, and Hereford and Plainview, they're paying 50 over. Honestly, they're making about 50 cents a gallon on ethanol, which is just incredible. Hand over fist, as they say, but they're much more interested in the distillers grains because of the protein market out there, because of the dairy industry, the burgeoning dairy industry. And we were talking earlier about the drought that's going on. So keep your eyes on that. I'm sure the next two speakers very competently will speak about that. And by the way, if you don't have a risk management program, I'd certainly encourage you to do that through these two guys that are about to go behind me. Years like this with the ups, we're looking at some $13 grain that probably should have been hedged. And, there's no reason to not do that. If you're going to be in business, you're going to be in business for a while. You need to visit with a couple of these guys and get your marketing plan in place. As far as that damaged crop continues, we're working with insurance agency, our folks in Lubbock. John Duff, some of you may know, is working with a bunch of insurance agencies to collect the data to get the quality loss on insurance to where it should be, and still on life support. And I probably wouldn't pass this too far down the line, is the quality loss adjustment, the QLA, which kicked in a couple of years ago for cotton and grains. It was a mess, but we've got some really good folks working on your behalf that maybe the QLA comes back in through the WHIP program. WHIP is in the continuing resolution, basically drought or excessive rain. So your counties are in those if you're in this area. So just another little deal on China. Wanted to do the numbers. A lot of this grain sorghum goes into Bajo, which is their drink of choice over there. It is the number one produced liquor in the world. They produce 0.41 million kiloliters a year, which is about 108 million gallons of Baijiu produced. 80% of the world's alcohol is drank by 20% of the world's population. That's a pretty good number until you realize the U.S. produces 13.9 billion gallons annually of liquor. So we've got a long way to go, got a lot of growth to do. Last number is a kill in China, the hog slaughter. They'll kill probably between 550 and 600 million hogs this year. They're trying to build their way to 800 million hogs. We're looking at about a 20% increase, and there's a direct correlation with their grain use and their hog kills. So we're looking at China needing to buy 20% more grain this year. Hopefully these guys will touch on that with some real numbers, but to give an index there, we've got about 130 million hogs in the United States. That's not what we kill, that's what we have. So when China lost half of their hog population a year and a half ago, they basically lost the equivalent to every hog in North America and Central America. So those are my comments, Matt. Please, if anybody has questions, give me a call. My cell phone number, Matt can put that up. Pretty easy reachable. I realized that when all this grain grading issues started getting hot, and everybody had my phone number. So they had no problem reaching me on that. And we appreciate that. Well, call us with your ideas and your concerns. That's why we're here, Matt. And,
Okay.
We enjoy those calls and we like working on those issues. So thanks, guys. Thanks for what y'all do. And Mark and John, thanks for letting me go first this week.
Very good. Thank you, Wayne. We appreciate it. I will put your phone contact information in the chat in just a second as we get started. We're going to move on to take care, Wayne. Have a safe travels. We're going to move on to Dr. Mark Welch, AgriLife Extension economist, and we're going to let you do your thing this morning. Good morning to you.
All right. Good morning, Matt. Great to be with you. Let me bring up my screen share this morning, and I hope that you'll be able to see that okay. And
yes, sir. I see it.
Really appreciate the comments from Wayne Cleveland there this morning as he talked about particularly quality issues. So many times we focus just on production and price, but also quality, whether we're talking about grain or cotton or any of our commodities. Quality and the grading system on which we all rely for a fair evaluation and appraisal of the value of our commodities that we produce is so important. And we appreciate the work of the grain sorghum producers on those quality, those grading, those quality adjustment issues that can become so critical in years like we just wrapped up. Of course, the grain harvest is pretty well wrapping up across the state of Texas. We're about 90% done on our corn crop. Nationwide, we're just over 50% complete now. And the issues I'd like to focus on in our few minutes this morning are a couple of reports that have come out since our last meeting this week in September. And of course, we get weekly progress reports that are so important to gauge our yield prospects. But a report that doesn't get a lot of attention that was released at the end of September was the grain stocks report. And these are so critical in grain in that we measure exports along on a regular basis. We keep up with how much grain is going to ethanol production, but we don't have a regular measure of feed use. And feed use is the #1 use category when it comes to corn. And so these grain stocks report give us a checkpoint as we move through the marketing year of the rate of feed use. And some numbers came out of that grain stocks report that were a little bit surprising for us. And then the combination of both of those reports, as well as a few other global adjustments, found their way into the October WASDE report and kind of reset our corn market fundamentals as we're wrapping up here at harvest. First of all, if you look at the crop condition ratings as we've gone through the year, the blue dotted line would be an index of what a normal crop year would look like. And the black line is this year's crop condition index ratings. And we've been about a normal year, which is surprising given the large amount of the northwestern corn belt that's been in extreme dry conditions all season long, back into last fall. But we've seen much better than normal conditions across the central and eastern portions of the corn belt. And in balance, the condition ratings have indicate kind of an average kind of crop. Now here right at the end of the year, our ratings dropped a little bit below what you would expect to be normal. But then the last couple of reports, the last 2 weeks, those condition ratings have ticked back up just a little bit. So just looking at a chart like this, you would anticipate, well, that would give some indication that this year ought to be maybe kind of a normal year when it comes to corn yields. And that's exactly where USDA is coming down right now on the 2021 corn crop. The yield estimate in the October WASDE was a little higher than September. We're now at 176.5 bushels per acre. If you look what an average crop ought to be given trend line yield growth, and this line you're seeing here goes back to 1950, that would project a yield here in 2021 of 176.7 bushels per acre. So that was consistent with those crop condition ratings we were just looking at of what looks like to be a kind of a normal kind of crop. That has implications for next year, of course, in that as we start to look at our price expectations, I'm going to plug in a yield next year of 178.7 bushels per acre. That would be about 2 bushels higher, which is the trend line yield growth, again, going back over the last 70 years, and would be an all-time record high corn yield. In fact, this year's yield at 176.5 is 1/10 of a bushel below the all-time record high of 176.6 bushels per acre, which again is just incredible given the large degree of area in the Corn Belt that had a pretty stressful growing season. This is what the grain stocks report looked like. And maybe that's not real dramatic other than you look at the what is the ending stock number for the 2020-2021 marketing year. So September 1st or August the 31st is the end of the marketing year. That number came in at 1.2 billion bushels, which is 36% below last year, 39% below the 5-year average. So that's a relatively tight level of stocks as we're wrapping up the marketing year. But notice something on this black line. You can see the rate of use that we were seeing through this last marketing year. And there's just a little bit of a kink as we go from June 1st into September 1. We did not continue on that same rate of consumption that we were seeing at the first part of the marketing year. And that's very important for that ending stock estimate number. And here's what explains that. Typically, in that December to March quarter, we use about 36% of the marketing year total use. We go to that third quarter, which is March to June, we normally consume about 33% of the marketing year total. And then in the fourth quarter of the marketing year, that June to September time period, we normally consume about 31% of the marketing year total. Well, in this most recently completed marketing year, the second quarter, December to March, right on track, right at just below that 36% level. Very strong export activity in the March to June quarter pushed that level of use up much stronger than would normally be. Very consistent. That line was straight as we were tracking our grain stocks number. But look what happened in that fourth quarter. Fell off sharply. We saw export activity slow down, and of course we knew that. We could plug in those numbers. The number we could not track was our feed use rate during that fourth quarter. And that's the number that got adjusted in the WASDE. With that slow or much lower level of disappearance in that fourth quarter, USDA lowered the estimate for feed use in the 2020-21 marketing year, and that went directly into increase in beginning stocks for the current crop year. And so here are the adjustments to the balance sheet. We saw total use go down for the old crop marketing year. That raised our beginning stock number. We had a higher yield that raised our production number. And we even had a small decrease in use with a slightly lower, again, feed use estimate in the new marketing year. So all those things culminated to a new crop ending stock estimate that was higher as we are now getting a better handle on the 2021 crop that, again, is about half harvested here in the U.S. So that starts to shape then our expectations for next year. What would our price outlook be given as we incorporate some of this information into to where we think we're headed? First of all, this black line that kind of goes at a diagonal across the chart, that is the level of production. That's 14.8 billion bushels of corn. So these would be the yield and the acreage combinations necessary to produce 14.8 billion bushels of corn, which if we keep use steady in the new marketing year, that would mean no change to the stock level from production, that we produce exactly as much corn as we will consume. using the yield of 178.7 bushels per acre, we can plant as few as 90 million acres and keep ending stocks unchanged. If we were to plant the same amount of acres next year as this year, you can see the degree to which we do start adding to that ending stocks number. And in my expectations at this point, and as we look ahead to next year, I'm keeping my planted acres number about the same, and plugging in that higher yield based on just trend line growth, a normal growing season across the Corn Belt. Then you can see that we would be at a point at which we're going to start adding to that stock estimate moving forward into the 2022 marketing year. And what that looks like for corn, our stocks to use ratio, or the days of use on hand at the end of the marketing year, here is the end of the 2020 marketing year. Here's 2021, the current estimate. We start pushing back above that 40-day threshold. This is a 30-day, this is 37 days, and now we're back up to just over 40 days. And if we were to do that, I think we would see that downward pressure on prices with a national average corn price around that $4 level. Now, most in Texas would see a better basis than what we see across the rest of the country, but kind of gives you an idea of where I think the downward pressure on prices will be next year. And of course, we're still in a very high price environment as we're wrapping up this 21 harvest, but we are seeing an interesting shift in that price relationship, in that the price of grain sorghum nationally is starting to slip relative to the price of corn. Still very, very high prices, but at this point, these are prices as of August. Of course, we've got a large portion of the grain sorghum crop starting to be harvested, particularly in Texas. Texas and Kansas account for the vast amount of grain sorghum production in the U.S. So the Texas crop was coming in at a very rapid rate here in August. So we're seeing a little harvest pressure on the sorghum price, and it's still a little early on corn. So we're seeing a little slipping in the sorghum basis, and the corn base is still very strong. So I think we'll see that corn price tip lower relative to grain sorghum, but we are seeing some adjustment in the basis as we'd normally expect, I think, here at harvest time. But still very strong prices for both corn and grain sorghum. So what does that mean? Well, I like to go back to this quote from Dr. Darrell Ray at the University of Tennessee, and this was back in 2008 when he made this statement that high prices have one certain result, and that's more acres. So the extent that farmers everywhere see these high prices, they're going to do everything that they can do, given the vagrancy and the whims of Mother Nature, to increase their production. I think the market support that we're going to see through this winter, however, will be what might the impact of high input costs due to those acreage estimates. So we're doing some work on that, particularly when we look at fertilizer prices in a high fertilizer use crop like corn. Can tell you that if you go back to about 1996, 1997, higher fertilizer prices correlate to higher corn acres, in that the price of fertilizer goes up when the price of corn goes up. And so there's a very positive correlation between those two. So will that have an impact this year? Perhaps given some profitability that we're seeing in some other crops, soybeans, wheat, grain sorghum, that would be less fertilizer intensive. And then, of course, be interesting to see what Dr. Robinson has to share about the cotton market. And of course, the prices that we're seeing there and the strength in that market. So that's all I have for this morning. Good to be with you. Welcome any comments, questions that you might have, and look forward to continuing the conversation. Thank you much.
Thank you, Dr. Welch. Appreciate your comments this morning. Lots of good information as always. We're going to move right along to Dr. John Robinson, also an AgriLife Extension economist, to talk a little bit more about cotton. So, John, can you hear me?
Yes, I
and
can.
The floor is yours. So I see your slides are coming up, and go ahead and play the show, and let's see if it will. There you go. You're good to go.
All right. Thank you. It's good to be with you. It's good to follow Mark because he touches on a number of the things in the fundamental way of looking at things that are going to be relevant for cotton as we get into that. So we get to reinforce each other. It's a good thing also that this is a monthly meeting that we have here, because it lets me put this opening slide up here. We've seen a lot of drama in cotton prices. This is what's happened in the last month. We kind of shot up. What is that? The high up here, the intraday trading highest that we got was about 116 something. So we just had this incredible. This was really over about within a 2-week period. It was hard to keep up with. I'd come to work and pour a cup of coffee and look, and we'd be, up 3 or 4 cents, up 3. This week it was steady. This week it was limit up, and then we kind of are back into a consolidation period, a consolidation pattern at a very, very high level, with lots of guesses about whether we're going back up to here, or whether we'll take a tumble down to here, or whether we're just going to hang into this situation now. But anyway, these old crop prices that we're seeing are, they're the highest that we've seen in 10 years. I'll touch on some of the reasons why I think we're where we're at. And this is one reason where we're at. This is my speculator slide, which I frequently have in all my presentations. So the movements in prices recently are way over here on the right side. There's the uptick. It's hard to see it, but it's a 15-20 cent uptick in cotton futures, and it is in fact associated with a big buildup of speculative longs. Not quite as high as the historically high levels, but it's another typical skinny upward peak where those guys will go in and add 20 or 30 or 40,000 cotton futures contracts for whatever reason is in their mind. I can't predict what these guys are thinking, but they're obviously targeting cotton amongst a few other commodities. They're targeting cotton because they have an idea that cotton's going higher and they want to benefit on that uptrend. So they're jumping on the bandwagon, and they're fueling this. Now, I did a little statistical exercise before today that would let me put a kind of a quantitative effect on how much they're influencing the cotton market. It's really not as much statistically if you include all this history. Basically, if this green area, if they add 10,000 contracts, that's good for just slightly less than a penny's worth of growth here. So since June, we've had a over 20 cent rally here, and I'd say about 8 cents of it is explained by this upward move in speculation. So there's other things going on besides this speculation. There are other speculators. There's index funds who are buying. There's fundamental things that are happening. And there's just random noise that's making prices go up. But anyway, we're in kind of a spectacular period. The point I want to make about this, the point I want to leave you with is, nobody knows what's in the mind of these speculator people. They could get out tomorrow because they want to take their profits, or because they get scared, or because something happens outside of agricultural markets, some black swan event, the pandemic flares up. Who knows? It's impossible to predict what's in the minds of these people that would make them sell this big position that they've built up. So I would just have people look back at history, look at some of the widths of some of these, like that peak right there. That's about 3 weeks long. So is that. This is a long standing over a couple months. These are short little in and out peaks. The pattern of history is that these people can be very, very brief. They can be, you could almost say they can be fickle in their buying and in their selling and in their influence on the market. So if you ask me, are we going to $1.20? My answer is, I don't know. But, where we're at today is a pretty high price. And just looking at history, these guys have a history of being in and out. So I wouldn't count on them to keep your market supported, for the next 5 or 10 cents of this rally. There may not be another 5 or 10 cents of this rally. Nobody knows, but just look at the history. That's what I'll leave you with. Like Dr. Welch was saying, in grains, here is the 21 crop balance sheet for cotton, and the big kind of question mark that the biggest variable here is what USDA has been guessing the production is, and they've been whittling down the production level, and they may or may not be through. I don't see any really huge adjustments left, but there's always room for surprises. It's only October. We could still have things come in, float in off the Gulf and mess up the harvest pattern. Or, as like last year, it turns out that we could just get the strippers in the field and find out we don't have as much cotton as we thought we did. So there's a few months left of uncertainty, and this number may get smaller, which will tighten up the ending stocks. There is that ending stocks number, 3.2 million bales, is, it's fairly tight, and it explains some of the movement in prices from a fundamental standpoint. It also explains probably what these guys were thinking. These hedge fund guys have been making a bet, basically, that there's not as much production out there. Maybe they've overshot it. Like I say, maybe they're going to take their profits. Maybe they're going to think they're wrong and be disappointed by what USDA tells them next month. Who knows? But that's been the bet, has been that there's not as much production out there. So again, we'll kind of have to see. But we're at a fairly tight level, and it could get just a little bit tighter. I'm going to build a case for why I think next year the 22 crop balance sheet is going to be somewhat in the same tight ballpark. So I'm going to start that now. I think the demand influences next season are going to be the same ones we have now, and that is, this question of, are we recovering from the pandemic, and can the disrupted shipping patterns around the world, lack of ships, lack of trucks, lack of shipping containers, is that going to hurt the recovering level of demand that we see? I hope not. I think, like Dr. Welch said, with corn, we're going to have similar acreage with cotton, but the biggest difference is that the weather is going to be drier than it was, and so that's going to keep things somewhat tight. So from an acreage standpoint, I use a comparison of corn prices and cotton prices to come up with a ratio here. This would be whatever the price of corn was yesterday, the futures price for the 22 contract divided by the 22 cotton price, which is 90 cents. You come up with a ratio of about 5.8, and historically that puts you right in the middle of this downtrend, puts you right at about 12 million acres, which there's what we planted in 21, and there's what we planted in 20. So it's kind of in the same ballpark. So I figure we're going to plant around 20, unless these price ratios change a whole bunch. The biggest difference is that we're already in a La Nina advisory. A La Nina effect is when the Pacific waters around the equator are colder than normal, and that usually makes it drier and warmer in the southern region, and particularly in Texas in the wintertime. And that's what that's what NOAA is forecasting, drier and warmer temperatures. So given that, I'm going to make some assumptions that we have a somewhat average yield, but that's a yield that consists of losing a bunch of dry land because it's warmer and drier. And so it's weighted by irrigated yields, a somewhat higher level of abandonment, again, because it's drier, and we lose a bunch of dry land in the southern plains. So it gives us somewhat tight supplies. And it basically suggests that we'll see prices in the range. If you think back, we spent most of the 21 crop prices were in the upper 70s, 80s, and then they broke out to the 90s and ran on up over $1. But this 80 to 90 cent range is probably where I would expect new crop prices to be trading. We're already there. Like I say, we're already at about 90 cents. So I think there's downside room, especially if we end up planting even more. I'm suggesting we'll plant 12 million acres because of prices, because of economics. If we have a 89 or 90 cent insurance price come next December, January, as a result of the way they come up with those insurance prices, they average December 22 futures. For you people, it would be, I think, in the latter part of December and early January. If that average is 89 cents or 90 cents, I can only imagine what dry weather and a high insurance price will do. We could add 1 million acres. Now, that doesn't mean that you're going to harvest much off that extra million acres, but we could have more planted and kind of more uncertainty. So there could be some uncertainty. There could be some fireworks about how big the crop is, and that could keep prices up, but it could also create a little bit of downside price risk. So if I was a grower thinking about next year, I might be thinking about doing some early pricing on some reliable portion of your expected harvest. And I'll come back to these numbers. This is my balance sheet. I figure we'll plant around 12, we'll harvest under 10. That's 18% abandonment with that yield per acre. That gives us a 17.5 million bale crop, which is a little bit lower than last year, but it's more in line with the 20 situation. And if we have this level of domestic spending and a little bit lower exports, again, we could come up with a number that's pretty much in the ballpark of ending stocks under 4. And if we result in that, then statistically it would put us somewhere where, this time next fall, we'd probably be looking at some futures price at or around 80 cents would be my guess. So again, we're in a situation where we're looking at potentially high prices, and really the thing to do is to have a plan to figure out, how early we should book some of those prices, and not let the opportunity slip away. There's my contact info. I'd be happy to answer any questions, Matt, that anybody might have.
Very good, Dr. Robinson. Thank you very much. We appreciate you. We appreciate all our speakers this morning. You see, please put his contact information up there for you. If you have questions for any of our speakers, please reach out to them. They're real good at responding to those questions. We want to thank our presenters this morning. We also want to thank our sponsors one more time, the Cotton Board, Texas Corn Producers Board, and Texas Sorghum for bringing you this program. We will be back with you next month, same time, 7 o'clock. And we thank you for your participation this morning. Thank you, everybody.
Good to be with you, Matt. Thank y'all.
A lot.
Thank y'all. Have a good day, folks.